We'll also touch upon the data that we have gathered from entities whom we rate in our portfolio on their desire to seek the loan restructuring relief from the lenders, and we'll compare it with the data that we have, again, pertaining to our portfolio, pertaining to the entities that had sought the moratorium relief in the March to August period. In the third section of the presentation, we'll touch upon the operating and financial performance trends of the corporate sector, what we are deriving, what meaning we are deriving from that data, and then, of course, we'll link it to how we think this data is supposed to be understood and what does it mean, what implications does it have for the credit risk as a whole, and what's our broad outlook for the corporate sector ratings. So in the first section of the presentation, we'll discuss about the trends in rating actions. So this is a slide where you see that there are the chart towards the left gives the number of upgrades that ICRA has done since FY 2017 until the ongoing fiscal. The past 5 years, you would see that the trend in upgrades has been consistently coming down. The number of entities in absolute terms that have been upgraded, of course, has been coming down, but also that because this element can have variations because of the size of the portfolio, what you could also see is that even on the basis of the number of entities upgraded as a percentage of opening entities, the trend line suggests that the upgrade momentum has clearly fallen off. So here you would see that against the historical upgrade average of near about 10 to 11%, and even if one were to go prior to the year FY 2017, we did see that our portfolio, roughly 10 to 12% of entities were upgraded every year. But in FY 2020, and also based on the trend that you've seen in FY 2021 so far, we expect this percentage to fall down to near about 5 to 6%. That's it. So it's clearly going to be a year, the past 2 years consecutively, we would see that the upgrade momentum clearly falling off. And in contrast, as far as the rating downgrades are concerned, there has been a consistent rise in the number and proportion of entities that ICRA has downgraded. So this chart depicts exactly that against a downgrade proportion of close to 10%, 11% that used to be the proportion in FY 2019 and in the years prior to that. Both FY20 as well as FY21 so far indicates that the downgrade momentum has been on the ascendancy, and the proportion currently stands at around 16 to 17%, and that's been true for both FY20 as well as the ongoing fiscal. So with the longer term trend spoken about, this slide is about what's been the monthly trend in rating actions. So this slide is not just about downgrades. This slide is also about the number of other negative rating actions that ICRA has taken between March 1st, 2020 until October 31st, 2020. So here negative rating actions is to be understood as both downgrade of the rating as well as change in the outlook on the long-term rating. And the change in outlook could be to negative from stable or to stable from positive. So here again, you would notice that starting from the month of March, the number of downgrades that ICRA has done has been clearly quite high against the monthly average of 49 downgrades in FY20. We've seen that, of course, there's been a volatility in the count of downgrades for various reasons, but the overall trend line has been quite similar, in fact, higher than the number of downgrades that ICRA had done in FY 2020. But on top of that, over and above the downgrades, the number of other negative rating actions, including changing the outlook to negative, has clearly been much higher in the ongoing period, starting from March 1st, 2020 until now. And this wasn't as much the case in the prior years, not even in FY20. So far, 21% of ICRA's rated portfolio has seen a negative rating action. Now, one can also say that 21% is a small number. That could also be a line of thinking. But then one must also take into account the fact that there were several measures that the central bank had taken. For example, the lenders were given the permission to extend moratorium to the borrowers. and that, of course, brought in a lot of liquidity relief to the entities concerned who availed the moratorium. And so it had a positive impact in the sense that the downhill could have been worse, but for these types of reliefs that the central bank offered. Of course, at a systemic level, also there were liquidity enhancement measures that the central bank took, which also made sure that availability of finance was not really a constraint. Now, moving on to the sector-wise trends, this slide presents the top 10 sectors in ICRA's portfolio which have seen a negative rating action in the same period that the previous slide talked about, that is between March 1st until October 31st, 2020. And here you would see that the textile sector, real estate, hospitality, these are the various sectors that have seen a lot of negative rating activity. Now, one reason for this is that ICRA has a high coverage in these sectors. So the reason that count is higher is because the portfolio size is higher. But aside from portfolio composition attributes, if we also look at the proportion of entities in these sectors that have undergone a rating change or where the outlook would have been made negative, you would see that almost more than 1/3 of our textile portfolio has seen a negative rating action. The highest proportion has been in the hospitality sector. And of course, that's not really something which is surprising. The hospitality sector has been one of the worst impacted sectors because of the pandemic. And the rating actions have also been a reaction to what we believe that the outlook for the hospitality sector portends. Now, these percentage figures that you see here, these are for the top 10 sectors, as I just mentioned. So you could see this in relation to the overall portfolio average, which was that for the portfolio as a whole, 21% of our portfolio has seen a negative rating action. Contrast this to what we see in the hospitality sector, 73% negative rating actions. And of course, there are many sectors which are not present on this slide where the percentage of negative rating actions would be far lesser than 21%. So sectors like FMCG, IT, pharmaceuticals, these are some of the sectors where the tendency, the downgrade momentum has not been there because these sectors have shown greater resilience. Now, coming to this data point relating to which are the entities, what proportion of entities sector-wise availed the moratorium relief. Now, this is purely about ICRA's portfolio. And we are comparing this against the data that we have currently for the percentage of entities in our portfolio that are desirous of seeking a loan restructuring relief from their lenders under the August 6th circular of the RBI. Now, here you would see that on a portfolio basis, we did see that 27% of entities in our portfolio had sought a moratorium relief. And this could have been a relief that the borrower sought for 1 month or 6 months, depending on the choice and business position. But in comparison to this figure of 27%, as far as loan restructuring is concerned, only 2% of entities in our portfolio have already applied for, or are intending to apply for a loan restructuring relief from their lenders. So clearly, this data point shows that the entities have not been that keen to avail the loan restructuring relief. So as far as the various sectors are concerned, hospitality sector clearly has been the most adversely impacted by the business disruption, demand issues. And in this sector, only 22% of entities in our portfolio have so far expressed that they would be keen to take a loan restructuring relief. Intuitively speaking, we would have expected this proportion to be much higher, but that's not the case. And one reason for that is that many entities, at least in our portfolio, belong to either a very strong promoter group, or some entities are also very low leveraged, so they have been able to tide over this period of stress better than some of the other leveraged entities. These are some of the reasons that we have seen that could have been some of the reasons why entities, even in the hospitality sector, decided not to avail the restructuring relief. Among other sectors which are seeking a restructuring relief, the numbers are anyway low single digits. But yes, the ones that you see on your screen, uh, auto dealers, real estate, roads, these are the other three sectors apart from hospitality where we have got the data where entities have indicated their desire to seek a loan restructuring relief. Now, the obvious question becomes then that why, in this period of unprecedented stress on business conditions, entities are choosing not to seek a loan restructuring relief? What's going on in the background? So, multiple reasons could be there in our view for this. The foremost reason, in our view, is that if a borrower goes for a restructuring relief, then that account gets tagged as a restructured account. So borrowers believe that if this happens, then in future, if they want to borrow more funds, then it could harm their possibilities of borrowing. Lenders might not be keen to extend loans to them. So this is one of the disincentives that we think could be working. The other thing is that the August 6 circular of the RBI mentions that once a borrower decides to seek a loan restructuring relief, then it would need to route its business receipts and the repayments through a designated escrow account, which would be maintained by one of the lenders in case it's a consortium banking or a multiple banking arrangement. So, which would obviously mean that the borrower seeking loan restructuring relief will have to be open to the idea of ceding control of their cash flows once restructuring happens. So, this again could be one of the disincentives for the borrowers to not go for a loan restructuring. But then they could also be seeking other relief modes without the account being tagged as a restructured account. So this slide also mentions these alternative relief modes. We believe that because many of these entities took a moratorium relief, they do have the wiggle room to stay put for another quarter, 2 quarters, even without seeking a loan restructuring relief. And also, in many cases, we do sense, particularly in the real estate sector, that where the lenders have sanctioned some additional loan facilities to the borrowers for them to tide over this period. Also, in many under construction projects, we've also believe that many of these entities are going to seek a DCCO extension, where once the regulations allow for these commercial this completion and commercial operations date to be shifted by at most 2 years without the account being tagged as a restructured account. So this too could be one of the relief modes that at least some of the under construction projects might be seeking. Of course, there since the uh, withdrawal of the lockdown restrictions, business recovery has also been seen. We've seen many sectors reporting a sequential improvement in business volumes. Margins have also improved because of the cost cutting initiatives being taken by many of the borrowers. So, because of this, because of business recovery, also some entities might be better off than what they would have believed to be the case uh, at the onset of the lockdown. And finally, there is also a possibility that we are seeing a borrower behavior change for the good, whereby because of some of these developments, like let's say the coming into vogue of the IBC, we might be seeing that promoters are the borrowers, the promoters uh, have become more credit culture conscious, and it could be a possibility that because of this, they are thinking that loan restructuring relief might not be uh, taken because the ability to pay the dues is better than it was, let's say, 6 months ago. So these are the four factors that we think could be working in the background for what we are seeing currently in data for loan restructuring relief, which has been quite less compared to what we were expecting. 3 months ago, our stated stance was that we were expecting around 7 to 8% of borrowers seeking a relief, but that number, as I was mentioning, is only roughly around 2%. So the next session, I'll hand over the presentation to my colleague Shruti, and she'll explain about what's been happening in corporate India as far as operating parameters are concerned, and as well as the financial performance. Over to you, Shruti. Thanks.
Thank you, Jitin. So here we'll try to showcase some of the recent consumption and industrial trends which has been visible through various sectors. Given the general uncertainty with regard to the overall macroeconomic environment, the consumer sentiment continues to remain subdued, as you can see from the graph on the lower right. However, the general consensus towards recovery going forward has increasingly turned positive over the past few months as compared to the period under lockdown when there was significant uncertainty regarding the near to medium term prospects. Other factors influencing the consumer sentiment, such as employment rate, also witnessed improvement as the year progressed. For instance, the unemployment rate, which had peaked during the lockdown phase, steadily improved as the restrictions eased, and this allaying of fears related to income security has contributed to stabilization of sentiment. The clear silver lining in these trying times has been the rural economy. Rural sentiment had been positive after two healthy crop cycles of Kharif and Rabi in 2019, and furthermore, the first advance estimates of the 2020 Kharif season also indicate at an improvement in production levels across most crops, likely to result in another bumper crop. This, coupled with higher procurement of crops by the government and increase in MSPs, has improved cash flows for the farming community. Moreover, healthy reservoir levels, aided by a normal and timely monsoon, have aided the Rabi crop sowing as well, which is higher by 28% on a YOY level so far. This would further augment farmer cash flows, helping to maintain the optimism in rural sentiment. We are now on slide number 14, which summarizes the recent performance across sectors and the recovery to pre COVID levels. As you would imagine, the impact of the pandemic and the stringent nationwide lockdown has been broad based across sectors, leaving very minimal number of sectors unimpacted. However, the latest data from most sectors suggests that they have recovered to 75 to 100% of pre COVID levels, a healthy improvement from the 60 to 85% levels witnessed during June to July 2020. However, sectors like aviation, hospitality, and commercial vehicles have been hard hit by the pandemic, and even most recent data indicate that the road to recovery would be a prolonged one. As mentioned earlier, the travel and hospitality segments have been the most impacted by the pandemic and are expected to take much longer to revert to earlier levels. The daily airline passenger traffic, while improving sequentially over the months, still continues to remain at around half of pre COVID levels only, given the continued restrictions, especially on international travel, and the high risk aversion towards travel, although it is improving. The relatively slow pace of recovery is also visible in the hotel segment, where occupancies had crashed to historic lows in Q1 FY21 and have remained depressed, despite some quarantine related and healthcare staff traffic diverted to hotels. While the traditional business is slowly coming back, especially from leisure segment, business demand is unlikely to make a major comeback anytime soon. The road to recovery will hence be longest for these sectors, with ICRA expecting recovery to pre-pandemic levels to be a two to 3 year phenomenon at the very least. Slide 17 shows the recovery in the QSR and retail segment, which has remained slow, with general wariness regarding public spaces impacting such discretionary spends. However, while the same-store sales growth at major retailers and QSR players continue to be in the red during Q2 FY21, there has been a recovery from the troughs witnessed in Q1 FY21. The relative improvement has been more pronounced in delivery-focused formats, both in QSR and retail space, while stores that remain primarily dependent on dine-in sales or walk-in customers are witnessing a more gradual recovery. Accordingly, many retailers are gradually embracing online deliveries as a channel of distribution in order to stay relevant. We are now on slide 18, outlining the impact of the pandemic on the real estate sector, which has been mixed. The residential and retail real estate segments have been most impacted by the pandemic, given the high level of cash flow disruption. With people cutting back on large ticket discretionary purchases, housing sales expectedly contracted by 50% in H1 FY21. Furthermore, rent waivers in the range of 50 to 100% due to invocation of forced major closures affected the retail real estate segment significantly. However, the office and industrial segments continue to remain stable given that cash flow disruption has been relatively lower and is expected to remain so. Given the essential nature of products, the FMCG sector was among those relatively less impacted by the pandemic induced disruptions. Essential goods remained outside the purview of the lockdown, and hence the disruption in operations for FMCG players was also not as pronounced as other sectors. Additionally, healthy demand from rural India, which remained relatively less impacted by the pandemic, also supported volumes to a large extent. With consumers largely reverting to their pre-pandemic purchasing habits and online purchasing, including groceries, getting a significant fill-up from the lockdown period, the sector has bounced back to normalcy during Q2 FY21. Furthermore, the larger FMCG players have also been able to recalibrate themselves to the changed consumer preferences in terms of product categories, value packs, etc., which have helped them continue to expand their volumes in a challenging market environment. Slide 20 shows the recent trends in volumes of key consumer durable companies. As can be seen, after an expectedly weak Q1, the segment has bounced back appreciably in Q2, supported to some extent by pent-up demand, as well as increased spend on comfort of homes, given longer time spent at home post the pandemic. We're now on slide 21 of the presentation, which outlines the recent trends in the automotive sector. Here, the trends have been mixed. Subsectors supported by healthy underlying rural demand have posted faster than expected recovery. These include tractors, where volumes have surpassed previous year levels by a good margin right from June onwards and continue to remain so. Similarly, entry-level cars and motorcycles have also reported healthy recovery, aided by increasing preference for personal mobility and also some extent of pent-up demand, especially from rural areas. Accordingly, two-wheelers and passenger vehicles have recovered to more than 80% of pre-COVID levels. That said, the sustainability of the improved demand beyond the recently concluded festive season remains critical for industry recovery. Although the commercial vehicle segment volumes continue to remain sluggish, given continued challenges like system overcapacity, financing constraints, subdued fleet utilization levels, and fleet operator viability concerns plaguing the sector, the LCV truck segment has been the outlier, posting healthy recovery, supported by rural demand, e-commerce traction, and increased requirement for last-mile connectivity. While the construction sector has also reported sequential recovery in Q2 FY21 as lockdown-related restrictions eased, the same is yet to recover completely. The low single-digit growth and negative volume growth seen consistently in the steel and cement sectors for the past 1 year are indicative of a structural weakness in demand. While the order book of construction companies in ICRA's sample increased in the current fiscal, the same reflects significantly higher awards than execution during this period. Execution was impacted in Q1 by the lockdown and labor availability issues, but awarding activities remained strong for the sample set, contributed by higher road projects awarded by the NHAI and MORTH. Overall, the government's strong focus on the infrastructure sector under the National Infrastructure Pipeline is expected to aid recovery over the medium term. Moving on to the next section, where we will briefly touch upon the recent financial performance of corporate India. With the country remaining under a stringent lockdown for a major portion of Q1 FY21, with restricted manufacturing, industrial, construction, and consumption activity, the financial performance of corporate India was expectedly weak. However, there has been significant sequential recovery seen in Q2 FY21. As against the broad-based decline in revenues reported in Q1 on account of the lockdown, Many sectors have exhibited sequential growth in revenues in Q2 FY21, with even marginal YOY growth visible in some. However, revenue growth in select sectors like airlines, retail, and hotels remains deeply negative. When the country went into a period of stringent lockdown in Q1, corporate India adopted multiple cost control initiatives in order to stay afloat. These included waiver of rentals by invocation of force majeure clauses, retrenchment of workforce, salary cuts across various levels, as well as renegotiation of rentals, etc. Additionally, with the increased adoption of work from home culture and greater penetration of technology, other administrative expenses like travel and conveyance have reduced sharply. These measures helped arrest the extent of cash burn in the first quarter when revenues were negligible. However, as revenues have largely reverted to pre-COVID levels in Q2 and companies retained the benefits of a large part of these cost reduction initiatives, the profitability of India Inc. improved significantly with both operating margins and PBT margins at multi-quarter highs. On the EBITDA margin front, out of 34 sectors in our sample, companies in nearly 21 sectors witnessed margin expansion during Q2 FY21 on a YOY basis. However, ICRA does not expect these margin levels to sustain, given raw material headwinds due to firming up of commodity prices and gradual reversion of costs to pre-pandemic levels. Supported by the improvement in earnings, credit metrics also reported improvement during Q2 to a large extent. With the country coming out of lockdown restrictions, the pressure on earnings abated, which supported the credit metrics. Additionally, interest costs decreased by 4% on a year-on-year basis as companies cut down on their capex and working capital requirements, while also benefiting from lower system-level interest rates. Coupled with the 7% expansion in operating profits, the interest coverage ratio increased during this period. Slide 27 outlines the trends in financing. The beginning of FY21 had seen a sharp risk aversion to corporate bonds that was reflected in the widening of credit spreads on the back of demand for moratorium on servicing of bonds similar to bank loans. The winding up of a few debt schemes by mutual fund houses made matters worse. However, improvement in economic activity post the lifting of lockdown restrictions, various measures taken by the RBI to keep interest rates soft, and ensure ample liquidity in the system have improved sentiments and resulted in high issuances of bonds lately. While bank credit growth has been relatively slower, it has been partially offset by a significant rise in primary bond issuances and a healthy increase in bonds outstanding. Now I will hand back over to Jitin to take you through the final section of the presentation on credit risk factors and broad outlook before opening the floor for Q&A. Over to you, Jitin.
Thanks, Sudhi. So just last two slides of this presentation, just to tie whatever we have mentioned so far. So on one hand, there is data that suggests that a recovery is being seen, and this data is this conclusion is based on what we've been seeing in the operating metrics and the financial results that the companies have published in Q2 FY21. So clearly, Q1 was a period of a washout, nothing too much to write home about. But Q2 has shown that many companies, both in terms of revenue growth as well as EBITDA margins and PBT margins, have seen a strong improvement in the last quarter, the quarter that has just gone by. Now, the point that is noteworthy is that even prior to COVID, we talk about the period starting from Q4 of FY 2019. At that stage itself, there were signs that the GDP growth had started faltering. Incomes were not growing, consumption growth was plateauing, and in any case, the investment demand too was quite lackluster. But yes, when COVID struck and when lockdown was imposed nationwide, this really made matters worse, and one doesn't need to talk too much about it. Everybody's aware. But then Q2, as I was mentioning, has seen a recovery of sorts. But then, does this mean that a sustainable recovery is underway? Our view is that whatever signs of recovery we have seen in Q2, it's not sustainable. it's more a reflection of pent-up demand when in the period of lockdown, demand was under a leash, consumption was under a leash, and it just the Q2 number just reflect that demand, that pent-up demand surfacing and reflecting well on the Q2 numbers. But we believe that this recovery is not sustainable. Also, if we go back in time, we know that the financial sector was going through its own pain period. Uh, there was a general risk aversion against the financial sector entities, particularly NBFCs that were wholesale focused. But even for those NBFCs, financing conditions have improved on a relative basis in the last 5 to 6 months. Uh, Monetary policy has been a good contributor to this improvement. Uh, there, there were these, there were LTRO, TLTRO, coming down of systemic interest rates. All these have contributed well to enhancing the system level liquidity. So because of which, one of the factors of production, which is finance, that has been addressed to a large extent. So which means that if growth were to, let's say, immediately recover today, then absence of financing might not come in the way. But since an improved financing environment is only a necessary condition, not a sufficient condition to support, to spur growth, we believe that beyond financing, a lot more would be required. And as data points out, that consumption growth has been a clear laggard. There have been job losses in this extant period. There have been salary cuts. Businesses have closed down, which has clearly severely impacted consumption demand. Uh, Another point that one can make is that since many entities have also reported an improvement in profit margins despite revenue declines, what that would mean is that if if somebody's consumption is somebody else's income, so if companies have been cutting back on consumption, cutting down on costs, it would mean that somebody else, some other entity in the value chain, some other individual in the value chain would have got less money in the hands. So which means that this vicious cycle of downhill consumption would have is likely to we were likely to see in the coming quarters. Uh, Aside from consumption demand, now consumption demand contributes roughly 55% of India's GDP. So if consumption is under a leash, then obviously it will have implications for GDP growth. Aside from that, investment, which roughly accounts for 30% of India's GDP composition, there again, private sector capex has remained tepid, and it is likely to remain tepid in the foreseeable future because of already subpar capacity utilization. Of course, in this uh, milieu, the rural economy has been a shining light. The trends have been promising. Uh, Kharif season is just behind us, and procurement trends indicate that procurement has been on a high. Farmer incomes are expected to improve. MSPs have been rising. So, from that perspective, rural demand should provide some support. But of course, rural demand alone might not be able to carry the mantle of overall consumption growth. And finally, from the government standpoint, also a fiscal spending driven recovery is something which might be very difficult to achieve at this stage. Already, we expect that the fiscal deficit for the government of India for the ongoing fiscal would likely touch 14 lakh crore. So again, one would not be able to expect too much from the central government also to drive spending and growth. Uh, Historically, state governments have been contributing larger share to overall investments in the economy, but in this current period, even state government finances are not in the pink of health. So, because of all these factors, we think that the current recovery may not be sustainable. From a credit pressure standpoint, unless business recovery signs are seen on a broader basis, rating upgrades might be very few, much lower than what they have been in the as far as the historical trends are concerned. So we believe that the credit quality pressures on corporate India are likely to sustain over the foreseeable future, over the next 2 years at least. So with this, we come to the end of our presentation, and the floor is open to any questions and answers that the listeners might have.
Thank you. Good evening, everyone. Thank you, Jitin and Shruti, for a very elaborate presentation. We'll now request the participants to please share their questions. They can do so by writing their questions in the Q&A chat box, which is available at the bottom of the screen. So we have the first question on the rural economy part and its impact, which has been visible on many segments, particularly auto related to tractors and motorcycles, etc. So maybe I'll bounce this question to Shubhrato. Shubhrato, the question is that we've had very good monsoons this year. The Rabi crop was very good, and so far the expectations on Kharif are also panning out very well. So given these trends, what is ICRA's view on the sustainability of the demand environment in some of the relevant sectors?
Yeah, I think during the entire lockdown period, this segment which had strongly held up and supported the economy was the rural sector, partly because the lockdown impact was much more limited in the rural market. And also there was considerable support and effort on the part of the government to sustain that part of the economy. So I think the overall demand on the rural economy side has been holding up very well, and I think continues to be very robust. And going forward, also, I believe the sector is expected to hold up. The key challenge could be that if there is a spread of the pandemic, if there is a second or third wave. So if that happens, of course, there could be a negative or adverse impact. But barring a return of the pandemic, especially in the rural market, I think the recovery that we have seen in the rural market is quite sustainable. The demand is quite sustainable, and the rural supported economies, particularly two-wheelers, tractors, which are showing strong resilience, they should continue to hold very strong. Of course, some of the demands like the tractor segment, they are at a cyclical high. To that extent, there could be some moderation in the volume growth, but that's some kind of cyclical demand correction which we may expect in the next couple of years. But other than that, overall, the rural segment demand continues to be very robust and very strong.
Okay, great. Thanks, Shubhrato. Maybe taking another question which has come to us is that, what are the top three indicators, in your opinion, which you would follow to suggest that there is a true recovery in place?
So primarily, if we look at the current challenges are, of course, that the private capital spend that continues to be constrained. And of course, some of the capital intensive sectors, particularly construction and real estate related and segments which are to some extent had urban demand centric, those segments are coming back to normalcy, but they are still not back to the complete levels that we had seen before COVID. Also, we must understand the economy was slowing down during the third and fourth quarter of last year. To that extent, there was already a slowing economy. On top of that, the COVID lockdown happened. So I think the key factors would be one, of course, the return, the capital spend, particularly in the private sector, the return of private sector spend in the private sector, that will be a critical factor. And also, I think Karthik can add the financial sector in terms of the credit growth, that could be a significant indicator. So I think Karthik can elaborate on that.
Sure. Yeah, I think, Karthik, if you could share your views, and perhaps next couple of questions would also be for you.
I think from our side, immediate points for recovery would be the sustenance of the improvement in collection efficiency that one has been seeing companies report over the last 30-45 days. It does, at least as of now, seem to be better than our estimates. A continuation of the same would possibly be important. Credit growth, by and large, we still, again, this year is going to remain muted. Credit growth has been low. As of now, we really don't expect major credit growth. But yes, should the change in optimism towards the positive side, which has happened, if this continues, improvement in credit offtake could be one of the leading indicators on how the recovery happens.
Okay. Karthik, there's a question which perhaps is related, is that, what percentage slippages do we expect, in the restructuring proposals that are coming through, especially, given the demand supply dynamics, which are playing out?
It's see, that's a number which is quite difficult to predict. What I can say is, our own estimates that we thought for the financial sector we could see about 5 to 10% of the accounts may opt for restructuring, or banks and NBFCs may restructure. But here again, if we were to just look at the data that has come along with the Q2 results for a lot of these players, and even other commentaries by the various managements, most of them expect the restructuring to be in low single digits, in fact even finer than our estimates. So in one sense, that's a good number. That means possibly things are improving, but we still need to see, wait and watch to how these things really evolve. But by and large, we still believe, last year's, from a financial sector point of view, we could still see a couple of percentage definitely rise in NPAs, and as far as FY21 is concerned, we still need to redo the math. But if one assumes that the improvement in collection efficiency, which some of the players continue to maintain, that the performance remains good even in October month till date, then possibly there could be some lower level of year-end NPS as what we had anticipated. We were looking at about a rise in NPS by about 2 to 3% at least for NBFC sector, which could possibly be lower depending on how things play out. Similarly for banks also, an estimated NPA rise of about 3 to 4%. Should the momentum on improvement in collection efficiency continue, the numbers could be slightly lower. How much? I think it is better to wait at least till end of December, by when we would have some better sense of what quantum is getting restructured, and more importantly, by then hopefully there would also be clarity on the Supreme Court ruling on asset classification.
Okay. Karthik, there's another question which perhaps again I would request you to take up. Now, in one of our presentation slides, Jitin talked about the fact that, what could be the possible reasons for the proportion of entities opting for restructuring being low. Now, question is on that, has the government's guaranteed emergency COVID line program been also one of the important factors, for companies not opting for restructuring? And my sense is, I think this question would be perhaps much more relevant for MSMEs and smaller corporates.
Again, partly yes, because the GCL facility is about 3 lakh crore. What we understand, close to 2 lakh has been sanctioned, and possibly about 160 or 170 has been disbursed. So that's a fairly large sum, and that definitely to an extent has helped. But again, out here, I guess more importantly, everybody, including MSME, have been on cutting on expenses and costs, so possibly some benefit on the other side as well. And clearly, in the current environment, there is no capex or no other expenses. With slowdown in business, your incidental expenses are also lower. So all these have possibly led to companies not opting for restructuring. It could also be that it's still early days. Technically, you still have about a month more as far as the restructuring window is concerned. But again, October and November have been a bit optimistic on various macro indicators as well as sentiment. So it could also be, let's wait for another couple of weeks, and should this momentum continue, then we may not need restructuring. So it's better to wait till end of December. I think that would be a better time to know what's the quantum of restructuring is. But at the same time, yes, I do agree the measures taken by the government and the regulators have also helped on entities not needing the restructuring. We must bear in mind that this restructuring is purely for COVID related. It's not for other chronic cases or anything. So these were the accounts which were any case doing pretty okay from a lender's perspective till end of Feb. So barring some industries or some segments which would have been more severely impacted, logical guesses, not many would take for restructuring, because as economy shows signs of recovery, they may be able to service their dues.
And Karthik, this would also be reflected in the collection efficiency numbers for some of the retail asset classes. I mean, if you could elaborate on that.
Instead, the collection efficiency numbers for a lot of banks, NBFCs, especially on the retail loans, have continued on a positive trajectory over the last couple of months. September, the collection numbers were much better than what one had seen in July, August. What we understand is the momentum seems to continue for October and early November as well. The only thing one needs to be careful is it because of you've not really made payments, or a large part is still availed of the moratorium, and maybe one or two AMIs are getting cleared in September and October, and would this trend really continue going forward?
Okay. Thanks, Karthik. Subrata, we have a question on the hospitality sector, and it says that when do you expect the revival for the travel, tourism, and overall the hospitality sector to really come in? I mean, while we've seen that in Q2 there was some pickup, especially in the leisure segment, with staycations happening and the occupancy levels improving, but still we are not out of the woods yet. So.
Yeah, the hospitality sector, along with the aviation segment, has naturally been the worst hit by this pandemic because of the forced lockdown. In fact, current year, the FY financial year 21, we are expecting overall RevPAR pan-India to be lower by about 60% compared to last year. So while there has been some sequential recovery, both in terms of occupancy, they still remain at a very low level. Also, there has been significant efforts at cost reduction, which included overhead and employee cost reduction, as well as also there has been significant recovery in some of the F&B segment, particularly in the urban centers. But these are something which are sequentially positive, but still cannot take the industry into the positive zone. So our expectation is that while demand recovery will continue to remain slow because of the overall lockdown related issues, the supply side is the positive. There already the supply expectations across India was expected to be subdued. I think that will get deferred further. So to that extent, there will be some relief. We expect maybe in 2 to 3 years time, the industry will more or less come back to the level, at least 2 years level, to come back to the level where it starts by financial year 23. On an aggregate basis, we would expect the industry to start recovering its cost of capital, because today it's a very capital intensive industry, and today with the kind of losses or low profits or break-even levels that some of the hotels are operating, they are not recovering their cost of capital. So even to bring back to the level of recovering their cost of capital, it will take probably a couple of years. But then again, it's a very cyclical industry and the operating leverage is high. So with reduced supply pipeline, with significantly deferred supply pipeline, maybe 2 or 3 years down the line, we'll start seeing much better days.
Sure. And I think at the same time, one would expect some level of consolidation also to happen in the sector with some weaker players exiting.
Yeah, that is a possibility. I think some of the weaker players, especially the ones which are not currently operated by hospitality chains or people with hospitality background, because a lot of real estate or developers who entered this business, so some of them could be seeking exit because of the challenges they are facing in their other businesses. So there would be certain amount of consolidation, but even today, one, of course, the capital availability, even with the acquirer, is a challenge. And at the same time, even the valuation expectations are also still not normalized. But maybe over a period of time, we'll start seeing consolidation happening in the industry.
Sure. Jitin, if I could come to you next. I mean, the question is slightly broad-based, and one is seeking comments on what are the key factors that are going to bring in sustainable growth in sectors like infrastructure over the next 2 to 3 years, including real estate.
Yeah, I think overall for the economy as a whole, as Subrata and Karthik mentioned, two of the key indicators that would suggest that recovery can be considered to be more broad-based and sustainable would be: one, when private investments increase, and two, when credit offtake also starts showing signs of growth. Overall, if we look at the financial sector and its linkages with the real estate sector, now NBFC sector has been one of the sectors where the wholesale book was considered to be one of the pressure points, and it was expected that if the frenzy that was there in not too long ago for some of these financial sector entities, these NBFCs to extend loans to the real estate sector, and asset quality pressures began to be seen. So real estate sector was supposed to be one of the pressure points which could have negatively impacted the financial sector. And when a particular piece in the financial sector that gets impacted, that obviously has reverberations across the real economy and the financial sector as a whole. So that part has to some extent been addressed so far because of the liquidity measures that have been taken, and to some extent the possibility of this pack going down has been mitigated because of these relief measures. But again, it's a fragile situation still, because real estate also one of the broad barometers of any economy's growth, currently is not growing well. We've already seen that last quarter, roughly 30% decline in revenues was experienced by the real estate sector as a whole. But because of this, the financial sector's asset quality continues to remain a question mark. Right now, DCCO related comments that we made a short while ago, that has come to the rescue, but that can only help so much. For the economy to show a sustainable sign of recovery, I think real estate sector, which has many positive externalities, that sector has to recover. So far, that's not been the case, and whenever that happens, I think it would be helpful for both real sector as well as financial sector. And when both these engines start firing, then to return.
Okay. So maybe if you can just stretch your breath once more and give us your indication of which sectors do you think we feel at ICRA going to relatively stand out in the current fiscal, and also our economic growth expectations for fiscal 21.
So two broad sectors where we think that growth would be better compared to the rest of the pack. One, of course, is the sectors where the rural economy is going to be consuming. So which would mean that the FMCG space, the tractors, the two-wheelers, again, there's a bit of recency effect playing in our minds, which is making us conclude that the trend lines that we've seen in the recent past would continue to stretch, and we're going to be continuing seeing an uptick in these sectors. But we believe that at least over the next 2 years, as Subrata was also mentioning, rural demand is going to be an area where we aren't expecting any major concerns at this stage. So which means that these sectors which have an agreed demand base should do well. Apart from this, of course, the other two sectors would be the IT sector and the pharmaceutical sector, where we think that there's no structural disruption that has happened, and things should look up. Structurally also, pharmaceutical, medical devices, these are those two sectors where the PLI scheme is also going to be applicable. So those investments should also help in growth in these sectors, apart from the other manufacturing sectors like textiles, auto, battery manufacturing, and of course the solar modules. So there are these many structural changes that are also happening in the Indian economy, but the efficacy of these structural reforms, agriculture reforms, land reforms, labor reforms, corporate tax cut, all these are going to play out not until the next couple of years. There could be a period of pain in over the next couple of years, and then based on these structural reforms, one can expect a recovery.
Sure. A similar question, it has been on our minds that capex cycle in India has been delayed for quite some time, and pandemic has been another blow to that. So do you think the capex cycle is going to get even much more deferred now by the overall private industrial sectors, or one can expect some sort of investments to come back maybe from fiscal 22, especially driven by stabilization of the demand environment and government's schemes such as the PLI one, which has recently been launched?
Yeah, I think for India's GDP composition, 30% of the GDP is constituted by investments. Now, within this 30% pie, until 2 years ago, the contribution between public capex, which comes from the state government and the central government, and private capex, was tilted in favor of 55% central and state government and 45% private capex. But then what has happened over the past couple of years is that because of weakening of the flexibility of central and state governments, this ratio 55-45 has turned the other way. So this 100 basis points, so this 10 percentage points reversal of composition mix has meant that there has been a relatively greater reliance on private sector capex. Now, what this means is that if demand becomes a pressure point, which means that capacity utilization is going to be something which is supposed to be industries are supposed to be worried about, then private capex will not happen. It will get postponed. Private capex is likely to get postponed, which is your question, by when we can expect private capex to resume. We expect that capacity utilizations are not going to be improving at least over the next 1 year. Only later, beyond that, we would see that on an organic basis, as time goes by, companies amass organic surpluses. That is going to be redeployed into capital expenditure, and then the cycle continues. The other force is the import substitution, where again there are some manufacturing sectors where there are strategic advantages of trying to source raw material and finished goods from within India. For others, it's just that multiple countries have multiple comparative advantage, and we can't really help too much. We can't really do too much about it. So the areas where India's reliance on self-sufficiency is going to get a push from public sector investments, central government support. Those sectors should do well, and those PLI sectors that we just discussed, those would be the areas where private capex will give a leg up.
Sure. But I think what will remain to be seen is that whether those sectors can really move the needle, because some of the very capital intensive sectors such as power, cement, steel, etc., especially on the power side, I think thermal, etc., may not see major investments being announced in the near term. So it would, I think, one will have to really see whether those investments can really move the needle, I think. So yeah, it's a fair point. So we have a couple of questions which are, I think, very specific to certain sectors like city gas distribution and our outlook on certain sectors of the power industry. So I'll request the participants to please share. I mean, we'll respond through our sector experts to these questions. Shortly after this call. So I think with this, we are done with the Q&A. and I'll hand over the presentation back to Subroto for his closing remarks.
Thanks, everybody. Thanks, Jiten, Shruti, Shamsher, for an excellent presentation. And thanks all the participants for dialing in. You can get in touch with us through email and the phone numbers which are given in the PPT. So we'll be happy to respond to you offline, whatever queries you may have. Thank you.
Thank you.